You now know that a call profits when a stock rises and a put profits when it falls. But knowing the direction is only the first decision. The second decision, and the one that determines how much you pay, how likely you are to profit, and how much time you have, is choosing the right strike price and the right expiry date. Get these right, and a winning directional view translates into real profit. Get them wrong, and even a correct directional view can still result in a losing trade. This video covers both choices in full, what they mean, how they affect your trade, and a clear framework for making the right decision every time. The strike price is the price that gets locked in when you enter an options contract. It does not move. The market can go anywhere. The strike stays exactly where it was the moment you entered. For a call option, the strike is the price at which you have the right to buy the stock. For a put option, the strike is the price at which you have the right to sell it. Here is what is critical. The relationship between the strike price and the current stock price determines two things simultaneously. First, it determines the probability that your option will have value at expiry. Second, it determines the premium, how much you pay to enter the trade. These two things move in opposite directions, and understanding that trade-off is the entire game. There are three zones that every options trader uses to describe where a strike sits relative to the current stock price. In the money, the option already has intrinsic value right now. For a call, this means the strike is below the current price. You could exercise today and profit immediately. For a put, in the money means the strike is above the current price. At the money, the strike is at or very close to the current stock price. Neither profitable nor loss-making if exercised right now. It sits on the line. Out of the money, the option has no intrinsic value yet. For a call, the strike is above the current price. The stock needs to move up before it is worth anything. These three terms, IDM, ATM, OTM, appear constantly in options. They describe how far the stock needs to move and how much the option costs. Here is the core trade-off you face every time you choose a strike price. In the money, options are expensive. They have high probability of retaining value, but they cost more to enter. Out of the money, options are cheap. They cost less, but the stock needs to move further before they become profitable, and the probability of that happening is lower. There is no free lunch here. A cheap out-of-the-money option seems attractive, but it requires a larger price move in a shorter time frame. An expensive in-the-money option costs more upfront, but behaves more like owning the stock. It moves more predictably. The right choice depends on your view. How far do you expect the stock to move, and how confident are you? Strike selection is a probability decision, not a price decision. Let us look at a real call example using Apple. Apple is trading at $182.50. You are bullish. Here are three strike options for a 30-day call. Strike 1, $175, in the money. Premium, $12 per share. Total cost for one contract, $1,200. This option already has value. Strike 2, $182.50, at the money. Premium, $5.80 per share. Total cost, $580. Strike 3, $190, out of the money. Premium, $2.10 per share. Total cost, $210. Three different risk profiles on the same underlying stock, the same expiry date, and the same directional view. The question is not which is cheapest, it is which matches your expectations. Now the same exercise for a put on Microsoft. Microsoft is trading at $415. You are bearish. Three strike options for a 30-day put. Strike 1, $425, in the money. Premium, $18 per share. Total cost, $1,800. This put already has intrinsic value. Strike 2, $415, at the money. Premium, $8.50 per share. Total cost, $850. Strike 3, $405, out of the money. Premium, $3.90 per share. Total cost, $390. The pattern is identical. The closer the strike is to the current price, the more expensive. The further away, the cheaper, but the more the stock needs to move before you profit. Same trade-off, different numbers. Here is a practical framework for choosing your strike. If you have high conviction that the stock will move significantly, and you want maximum leverage on a smaller investment, an out-of-the-money strike makes sense. The risk is higher, but so is the return on a small outlay. If you want a trade that behaves more like owning the stock, with steady, predictable movement, an in-the-money strike is more appropriate, even at a higher cost. If you are uncertain about the size of the move but confident about direction, an at-the-money strike is the most balanced choice. It gives you moderate cost and moderate sensitivity to the stock's movement. As a beginner, the at-the-money or slightly out-of-the-money strike is where most traders start. It balances cost against probability without requiring perfect precision. The expiry date is the deadline on your option. After this date, the contract either gets exercised or disappears. Before expiry, you can sell the contract, exercise it, or let it expire. The key concept is this: time is the one resource in options that only moves in one direction. Every day that passes, the time value of an option decreases. This process is called time decay, and it works against option buyers. The closer you get to expiry with an option that is out of the money, the faster it loses value, because there is less time for the stock to make the required move. Understanding how time affects your position is just as important as choosing the right strike. You can be right about direction and still lose money if you run out of time. Options traders categorize expiry dates into three broad groups. Short-dated, 0 to 21 days to expiry. These are the cheapest options available. They are highly sensitive to time decay. Value erodes fast, especially in the final week. Medium-dated, 22 to 60 days to expiry. This is the most common range for directional trades. Enough time for a thesis to play out, reasonable cost, moderate time decay. Long-dated, 60 days to over a year to expiry. These are the most expensive but give a stock the most time to move. Time decay is slower in the early stages, used for longer-term views or as a cost-efficient alternative to owning the stock. As a buyer, the general rule is, give yourself more time than you think you need. Underestimating how long a move takes is one of the most common and costly mistakes beginners make. Here is how time decay actually works in practice, using a simple example. You buy a 30-day at-the-money Apple call for $5.80 per share, total cost $580. Apple does not move at all during those 30 days. At expiry, your option is worth zero. You lost $580, not because Apple went down, but because time ran out. Now compare. If you had bought a 90-day option instead, the premium would have been higher, say $9 per share. But with 60 days still remaining after the same 30 days, the option still has significant time value remaining. It might be worth $7. You have not lost everything. Time decay accelerates as expiry approaches. The last 7 days erode value the fastest. This is why buyers need to manage time carefully. Let us compare 3 expiry choices on the same Apple call using a $185 strike. Apple is at $182.50. 7-day call, premium 55 cents per share. Total cost, $55. This is cheap, but Apple needs to move above $185 in 7 days. Any delay and the option is worthless. 30-day call, premium $3.20 per share. Total cost, $320. Apple has a full month to move. 90-day call, premium $7 per share. Total cost, $700. Apple has 3 months to reach the target. More expensive, but far more time for the thesis to play out. The $55 option is not a bargain. It is a lottery ticket. The right expiry is the one that matches the realistic time frame for your expected move. Here is the framework for choosing your expiry. Start with a question: how long do I realistically expect this stock move to take? If you have a specific catalyst, an earnings report in 2 weeks, a product launch, a Fed decision, and you expect a sharp reaction, a short-dated option can make sense. The move either happens or it does not. If your view is based on a broader trend, a stock recovering from a pullback, a sector rotating into strength, you need more time. A medium-dated expiry of 30 to 60 days gives the thesis room to develop. If you are positioning for a longer-term move, or you want to reduce the impact of time decay, go further out. The worst outcome is buying an option with the right directional view, the right strike, and watching it expire worthless because the move came 2 weeks after your contract ended. Strike and expiry are not independent decisions. They interact. A cheap out-of-the-money strike combined with a very short expiry is a high-risk, low-probability trade. Both conditions need to be right simultaneously. The stock needs to make a large move in a short time. An in-the-money strike with a longer expiry is the most conservative options trade you can make as a buyer. Expensive, but high probability and more forgiving on timing. The most common beginner setup, and the one this series will use for examples, is a slightly out-of-the-money strike with a medium-dated expiry of 30 to 45 days. It gives a reasonable cost, a realistic probability, and enough time for a directional thesis to play out. You will see this combination appear in every strategy video in this series. Let us put the full decision together using one complete example. Apple is at $182.50. Your view: Apple will rise over the next 4 to 6 weeks. Strong product cycle, solid earnings history, and the broader market is recovering. Decision 1, direction, bullish. Call option. Decision 2, strike, $185, slightly out of the money. Why? You expect a meaningful move, not just a small drift. A $5 move up is realistic. Decision 3, expiry, 45 days. Why? Enough time for the thesis to play out, not so short that any delay kills the position. Premium, approximately $4 per share. Total cost per contract, $400. Maximum loss, $400. That is the full setup: decision, direction, strike, expiry, captured in 3 clear steps. Here is what you now know. 1. The strike price is the locked-in price at which you can buy or sell. It does not move. 2. In-the-money options cost more and have higher probability of value. Out-of-the-money options cost less but require a larger stock move. 3. At the money or slightly out of the money is the most practical starting point for directional trades. 4. The expiry date is your deadline. Every day that passes reduces time value, and this accelerates near expiry. 5. Give yourself more time than you think you need. Being right about direction but wrong about timing is a losing trade. 6. Strike and expiry work together. Balance the cost of the trade against the probability and time frame of your thesis. That is video 3 complete. The next video covers how options are priced, specifically what determines the premium you pay, and why the same stock can have options at very different prices.